So now we would be focusing on numericals, where we would be preparing the schedule showing changes in working capital. And the question goes like this: from the following balance sheet of A Limited, you are required to prepare a schedule showing changes in working capital. And what they've done over here is they have given us the balance sheet. They have given us the balance sheet with the liabilities and assets, and they've given it to us for 2 years, 2009, 2010. And using these information, we are required to prepare the very first step, which is schedule showing changes in working capital. So before we start off with the preparation of the schedule showing changes in working capital, one important thumb rule that you have to remember is that while preparing the schedule, we are only focusing on current assets and current liabilities. So let's just quickly look at the assets and identify which are the current assets. So let's identify which are the current liabilities. So here, when we look, we see that we have land, machinery. These two are fixed assets. We have stock. So stock is something we will have to consider. Then we have debtors. Debtors is also a current asset. And then we have cash. Cash also we will have to consider. So we have three current assets over here. Now let's move on to the liability. So we have capital. Capital is not profit and loss account. It is as good as net profit. Creditors, yes, this is a current liability. Then we have mortgage. Mortgage implies it's a loan. Okay, so it would be a long-term liability. So mortgage is not a current liability, it is a long-term liability. So we have three current assets and we have one current liability that we have to consider while preparing the schedule showing changes in working capital. Now let's move on. Let's start off with the preparation of the schedule showing changes in working capital. I've got the format over here ready, and following the format, what we will be doing is we will be fitting in the values over here. So here we will have to bring out the current assets, current liabilities. Then we have year 1 and year 2. Now for us, year 1 is 2009, year 2 is 2010. Okay, now let's look at which are the current assets that we have. So the current assets that we have here are stock. Stock is 9,000. Then for 2010, it is 7,000. So stock is 2,000 and stock in 2009 is 9,000. 2010 it is 7,000. Just give me one quick minute. I'll just make one small modification over here for you guys. And okay, now let's look at what impact does this have on our current liability. So if the change between year 1 and year 2, if it's bringing about an increase, we will capture here. If it's bringing about a decrease, that will be captured over here. So if you notice over here, between the 2 years, the value of working capital has actually, the value of stock has actually come down, and the impact it is having is that your working capital has decreased by 2,000. Your working capital has decreased by 2,000. So the impact that it is having is that it has brought down your working capital. Now let's look at the next item. The next item that we have is debtor. Okay, the next item that we have is debtor. First year's debtors value 16,500. Second year's value is 19,500. So here, first year 2009, it's 16,500. 2010, it's 19,500. What impact does it have? Here, what it is having is that here it has increased. Your working capital has increased. Now, how much has your working capital increased by? Your working capital has increased by 3,000. Your working capital has increased by 3,000. Next one is cash at bank. Okay, cash at bank. So first year's value is 4,000. Second year's value is 9,000. Okay. Now, if you look at cash at bank, it has increased. From 2009 with 4,000, in 2010 it has increased to 9,000. What impact it is having on working capital? Working capital has increased by 5,000. Okay, working capital has increased by 5,000. Now let's total up this. Let's total this up. Okay, let's total this up. And when you total this up, you would see that your total current assets for first year is it's 29,500. Here it's 35,500. Now let's move on to the liabilities. Now remember, we have only one liability, which is creditor. So we have only one liability, which is creditor. Creditor, here it's 9,000 and here it's 5,000. The creditor is 9,000, here it's 5,000. Now notice what has happened with current liability. Okay, notice what has happened with current liability. From 2009 to 2010, there is a decrease. It has come down, it has reduced. Now, by capturing this change in the current liability, we are trying to understand what impact does it have on the working capital. From 9,000, it has come down to 5,000. What impact it is having on the working capital? So when current liability reduces, working capital will increase. Okay, so when current liability reduces, working capital will increase. So remember the formula for working capital. The formula for working capital is goes like this: working capital is equal to current asset minus current liability. Current asset minus current liability. So here what is happening is this part, that is current liability, it is coming down. So when current liability comes down, okay, when current liability comes down, what will happen is your working capital will increase. Okay, when current liability comes down, working capital will increase. Okay, so that was the rationale. Now let's look at how will this impact. So what impact will it have on working capital? Working capital will increase by 4,000. Okay, working capital will increase by 4,000. So okay, now let's calculate the working capital. Now, how do we calculate working capital? Working capital will be total current asset minus total current liability. So here it will be total current asset minus total current liability. So here working capital is 20,500. So here it is 20,500. Here it will be 35,500 minus 5,000. Okay, 35,500 minus 5,000. Now notice between 2009 2010, what has happened with the working capital? So first year 2009 working capital was 20,500. Second year working capital is 30,500. So what has happened with the working capital? Working capital has increased. So that is what we are capturing over here. So there is an increase in working capital. So what we are doing over here is we are capturing an increase in working capital. So how much has your working capital increased by? Your working capital has increased by 10,000. Now, when you see this total over here, basically this increase or decrease, this is nothing but your balancing figure. Okay, it is nothing but your balancing figure. So we've captured the balancing figure, and total over here would be 30,500. Here also it will be 30,500. And the assumption that we have come to now is that the working capital has increased by 10,000. So with that note, we have completed the preparation of working capital, schedule showing changes in working capital, which is one of the first steps to for fund flow analysis.